Welcome back to the channel. Today is Friday, January 23rd, 2026, and we have a massive relief rally to discuss. If you were worried about a trade war yesterday, you can breathe a little easier today. In the last 24 hours, global markets have staged a significant comeback. The catalyst? A major geopolitical de-escalation involving the US, Europe, and Greenland. We also have a blockbuster US GDP report that is reshaping the recession narrative, and the Indian markets have responded with a strong gap up. We have a lot to cover in this detailed report. We'll break this down into three sections: the US market, the GDP beat, and the Greenland pivot; the Indian market, Nifty's recovery and sector-specific action; global markets and crypto, European relief, oil prices, and Bitcoin's latest institutional move. Let's dive straight into the numbers. Let's start where the action began: Wall Street. After a jittery start to the week, US indices roared back to life yesterday, January 22nd, closing firmly in the green. Here is how the major indices closed the session. The S&P 500 surged 1.16%, up roughly 79 points, to close at 6,875.62. Crucially, this move pushed the index back above its 50-day moving average, a key technical indicator that bulls were desperate to reclaim. The Dow Jones Industrial Average rallied 1.21%, adding over 588 points to finish at 49,077.23. The Nasdaq Composite, driven by renewed tech buying, rose 1.18%, climbing roughly 270 points to close at 23,224.82. The macro driver, the Greenland de-escalation. The single biggest driver of sentiment over the last 24 hours was political. Earlier in the week, markets were spooked by threats from US President Donald Trump regarding potential 10% tariffs on several European nations, including Germany, France, and the UK, over a diplomatic dispute regarding Greenland. However, speaking from the World Economic Forum in Davos, President Trump walked back these threats yesterday. He announced that a framework for a deal regarding Greenland's strategic use had been reached and explicitly stated he would scarp the threatened tariffs. This U-turn removed a massive overhang of trade war anxiety that had been plaguing global sentiment for days. Economic data: Q3 GDP beat. While politics set the mood, hard economic data provided the fuel. The U.S. Bureau of Economic Analysis released the Q3 GDP figures, and they were hotter than expected. The U.S. economy grew at an annualized rate of 4.4%, beating the consensus expectation of 4.3%. This data point is critical. It reinforces the soft landing, or perhaps no landing, narrative. It tells us the U.S. consumer is resilient and corporate America is still expanding, despite high interest rates. Bond yields and the Fed. Interestingly, despite the hot growth data, bond yields didn't skyrocket, which suggests the bond market isn't panicking about runaway inflation just yet. The 30-year Treasury yield actually fell to 4.848%. The 10-year Treasury yield hovered around 4.26%. Market participants are now laser-focused on the upcoming Federal Reserve meeting scheduled for January 28th. With growth this strong, the question changes from, will they cut rates to save the economy? To, can they afford to cut rates with growth at 4.4%? Corporate movers. Procter & Gamble, P&G, slipped 1.2% after missing revenue projections, flashing a warning sign about consumer staples. McCormick & Cohen slumped nearly 7% on a profit miss. Tech giants. The Magnificent Seven saw strong buying interest as investors rotated back into growth stocks ahead of their earnings next week. This risk-on mood was directly correlated to the easing of tariff fears. Now, let's shift our focus to India. The ripple effect of the US recovery and the easing of global trade tensions had an immediate positive impact on Dalal Street. Here's the snapshot for the Indian markets, January 22nd. Close, January 23rd. Sentiment. Nifty 50 reclaimed the psychological 25,000 mark decisively, closing up 132.40 points at 25,289.90. The Sensex mirrored this optimism, jumping 397.74 points to close at a fresh high of 82,307.37. Why did India rally? Global relief. India is highly sensitive to global trade winds. The removal of the US-EU tariff threat is a net positive for Indian exporters, particularly in IT and pharma, who rely on stable global trade corridors. The fact that the US president de-escalated the situation at Davos signals stability, which foreign institutional investors, FIIs, prefer. Oil prices. This is the most crucial macro factor for India right now. WTI crude prices dropped significantly, falling nearly 1.5% to trade around $59.72 per barrel. For an oil importing giant like India, sub-$60 oil is a massive boost to the fiscal deficit and corporate margins. Sectoral performance. PSU Banks, public sector banks, were the stars of the show yesterday. The sector is seeing renewed buying interest as valuations look attractive compared to private peers. Auto sector. We saw strong momentum in automobile stocks. This is being driven by expectations of cooling input costs, thanks to lower metal and energy prices, and steady rural demand. IT sector. With the Nasdaq rallying over 1% and the US GDP coming in strong at 4.4%, the fear of a US recession hitting Indian IT order books is fading. This triggered a relief rally in major IT counters. Areas of concern. However, it wasn't all green flags. The rupee. The Indian rupee remains under pressure. It is trading around 91.53 against the US dollar. Despite the weak dollar index, DXY fell slightly to 98.62. The rupee hasn't seen a sharp appreciation, largely due to sustained capital outflows. FII flows. Foreign investors are still net sellers, while domestic flows, DIIs, are absorbing the selling pressure. The persistent FII outflow remains a dampener on what could otherwise be a runaway bull market. Macro note for Indian investors. Keep an eye on the US dollar index, DXY. It dropped 0.13% to 98.62. If this downtrend continues, we might finally see FIIs reversing their stance and buying into Indian equities again. Finally, let's look at the broader global picture and the crypto markets, which have had a fascinating 24 hours. European and Asian markets. In Europe, indices like the DAX and CAC 40 rallied hard. The FTSE 100 in London is flirting with the psychological 10,000 level. The relief was palpable after Trump's comments on Greenland. European automakers and luxury goods stocks, which were in the crosshairs of potential tariffs, led the recovery. In Asia, markets opened today, January 23rd, tracking Wall Street's gains. The Nikkei 225 and Hang Seng are seeing positive momentum, fueled by the soft landing data from the US. Commodities. Oil. As mentioned, oil is in a bear market, trading near $59.72. This is bearish for energy stocks, but bullish for global manufacturing. Gold. Gold prices remained relatively stable. Despite the risk-on rally in stocks, gold is holding its ground, suggesting that some investors are still hedging against potential geopolitical surprises in the Middle East, or further Fed uncertainty. Cryptocurrency market update. Moving to crypto, the market has shown remarkable resilience despite some volatility in bond yields earlier in the week. Bitcoin, BTC. Bitcoin has pulled back slightly from its recent highs, trading around 89,620, down roughly 0.68% in the last 24 hours. It seems to be consolidating after its run toward 97K. Institutional news. The biggest story in the last 24 hours comes from London. iShares, BlackRock, announced the issuance of a new tranche of Bitcoin ETP securities on the London Stock Exchange, effective today, January 23rd. This is a massive signal of continuing institutional appetite for crypto exposure in regulated markets. Altcoins, Binance announced the listing of a new token, Sentient, Cent, which immediately saw a double-digit price surge. However, they listed it with a seed tag, warning investors of high volatility. Sentiment. According to a report by Bybit and Blockskulls released in the last 24 hours, the crypto derivatives market remains unfazed by the recent macro shocks, with leverage significantly lower than previous peaks. This suggests a healthier market structure as we head into the weekend. Conclusion and the road ahead. To summarize the last 24 hours, the fear of a transatlantic trade war has evaporated. The U.S. economy is growing faster than predicted at 4.4%, and oil prices are crashing to levels that benefit importing nations like India. What to watch next? All eyes are now on the January 28th Federal Reserve meeting. The market is pricing in the strong GDP data, but the Fed's commentary on inflation will dictate the next leg of this rally. If you found this detailed breakdown helpful, make sure to hit that like button and subscribe for your daily market intelligence. I'll see you in the next video.